It's really hard to and going to school and their ability
Good afternoon. For the University of Waterloo team, we'll be presenting our buy recommendation on Canadian Tire Corporation, or CTC for short. We'll be going over the business foundation, then growth potential, and focus on profitability, and wrapping up with the investment risks. We have a target price of $143, representing a 13% return from yesterday's close. CTC was founded in 1922 and was founded by the Bills family. They still hold the majority ownership of the corporation. Up until 2002, CTC consisted of gas bars, retail stores, and its credit card issuing subsidiary, CTFS. In 2002, CTC made its first acquisition of Marks. Marks is a specialty clothing retailer and allowed CTC to increase the store footprint by 320 stores. Then, for the next 10 years, CTC focused on solidifying its foundation, growing from 900 stores to 1,100 stores. In 2011, CTC made its second transformative acquisition, FGL. FGL represented a unique opportunity in the Canadian retail landscape, allowing CTC to acquire a national network of stores that it was in a new industry, sporting goods. In 2013, CTC launched the IPO of CTRE, unlocking the potential of 70% of its real estate portfolio. Since 2002, CTC has gone from being a general merchandise retailer to a complementary group of consumer companies. CTC is split into three operating divisions. The first is retail, and CTFS and CTRE. The revenue is mainly driven by the retail segment, but the profitability is driven by CTFS and CTRE. For this reason, we view CTR, the largest banner by revenue, as the foundation, FGL, the fastest growing banner by revenue, as growth, and Marks, CTFS, and CTRE as the profitability of CTC.
CTR is the largest retail banner by revenue and store count and competes in the general merchandise retail subsector with 498 stores nationwide. Through our analysis, we have found that CTR has consistently higher sales per square foot than the subsector average. We believe the drivers behind this performance are threefold, the first of which being the associate dealer agreement, in which dealers act as localized store owners and managers with a financial interest in store performance. We believe this helps to align the economic interests of the corporation and the dealers, and also helps to drive sales growth. CTR is also alone among their peers in offering this business model. We did a pricing analysis based off a basket of goods found across CTR's direct competitors and found that in a price-weighted basket, CTR is first against its peers. In an equal-weighted analysis, CTR ranks second among its peers. Also, that CTR offers a price match guarantee. We then scraped the internet for a mapping of all CTR locations nationwide and found that 89% of Canadians are within a 50-minute driving distance of a CTR location, beating its retail competitors. We believe this combination of convenience and affordability provides CTR a competitive advantage. To value CTC, we used a sum of the parts analysis, and to value CTR in specific, we used a segmented DCF model. Based off projections for same-store sales growth and store count growth, we project a 3% revenue CAGR for CTR through the terminal year 2020. This, combined with the terminal growth rate of 2%, gives us a valuation of CTR of $36, representing roughly 25% of the total target price per share.
Next, we'll be discussing FGL Sports, CTC's fastest growing segment. FGL boasts 433 stores across Canada, competing in the sporting goods industry under various banners. In our opinion, FGL's target consumers value two main things: selection and pricing, which go hand in hand. FGL is a standout business because it operates both big box banners and specialty stores, bringing an unparalleled selection of products to the market. We conducted a price basket analysis of FGL's banners and found that their pricing of products in line with their competitors, and their major banners offer price match guarantees. In recent years, FGL has embraced a digital strategy, bringing state-of-the-art technology into their stores in order to supplement their omni-channel strategy. We did a deep dive into the industry and found that non-chain stores in the sporting goods industry are losing market share. In addition, stores with revenue less than $5 million a year are largely unprofitable. This leads us to believe that larger chain stores, such as FGL's dominant banner Sport Check, will continue to gain market share. We valued FGL Sports using the unlevered DCF methodology. Based on management guidance and historical results, we forecasted 44 net new stores over the next 5 years and projected a revenue CAGR of 6.3%. This, combined with a terminal multiple of 9 times EBITDA, led to a target price per share of $17, representing approximately 12% of the total target price for CTC. Next, we'll be discussing CTC's focus on profitability, starting off with Marks. Marks operates 380 stores across Canada selling clothing specialized in industrial workwear. Through its product offering, Mark's caters primarily to Canadians working in goods-producing sectors, which represents 44% of working Canadian men. We visited stores that carry workwear in Canada and found that Mark's has a clear competitive advantage due to its broad selection of products. We view Mark's as an integral constituent of CTC's focus on profitability because it operates within the retail subsector that yields the highest gross margins, namely 54%. Due to weak commodity prices and the negative impact this has had on the demand for Mark's products, we believe that Mark's will be CTC's slowest growing segment at a 5-year revenue CAGR of 2%. Ultimately, we arrived at a price per share of $8, representing approximately 6% of the total target price for CTC.
This brings us to CTFS, the financial services arm. Now, we believe CTFS is strategically important for 2 reasons. The first is its role in reinforcing the retail business. Through its credit card portfolio, it offers rewards integrated with its loyalty program to drive customer retention. The second is its contribution to profitability. Though it makes up 9% of revenues, it contributes 40% of consolidated earnings. And its performance over the past 5 years has been an important driver in increasing corporate-level profit margins. Further, we believe as a differentiator, with it contributing CTC having the second highest EBITDA and net income margin of public Canadian retailers. To arrive at its valuation, we use the acquisition multiple approach. This approach values a business based on the acquisition multiple that was paid for it. Thus, the multiple we're using is what Scotiabank paid to acquire a 20% stake in 2014. Based on this multiple and its most recent earnings, CTFS is valued at $33 per share, representing 23% of our total target price. And with this, we proceeded to the final component of profitability, CT REIT. Prior to the IPO, its properties were accounted for in the retail division. And through the IPO, we believe 2 things were achieved. The first is the benefit to shareholders through the REIT structure, which offers more tax-efficient and reliable distributions than the corporate shareholder structure. The second is standalone filings, offering greater financial transparency, which we believe unlocks the value of its real estate portfolio. One major implication of this is a lower cost of debt. This past summer, CTC issued its first non-intercompany debt, illustrating its ability to issue debt at a lower cost than CTC. Thus, we believe CT REIT enables CTC to optimize its capital structure. To arrive at its valuation, we used the trading multiples approach. Here we analyze public Canadian retail REITs, and using the median FFO multiple of this comp set, we arrived at a valuation of $32 per share, representing 22% of our total target price.
To recap, we valued the foundation, the growth, and the profitability of Canadian Tire. Now, there are 2 small parts remaining. The first is petroleum, which we value using an unlevered DCF methodology, similar to the other retail divisions. We came to a valuation of approximately $5 per share, representing 3.2% of our final target price. And the final segment is cash and cash equivalents, which accounted for $12.38 a share. In total, with a 35% discount from the voting shares, this makes up our $143 target price. After we finished this analysis, we ran a Monte Carlo simulation to understand the sensitivity of our model, and after running it, we found that out of the 100,000 trials, 54% of the trials were above our target price.
Finally, we'll be discussing CTC's key investment risks. To better understand the threat of these risks, we plotted them on a matrix by likelihood and impact, 3 of which we've identified as most significant. We'll now be discussing in detail. The oil and gas industry has seen 2 years of downward pressure on commodity prices. We believe this results in layoffs, wage cuts, and discontinued capital investments. For CTC, this ultimately has the potential to decrease property value, increase bad debt, and decrease revenue. We ran a scenario analysis to quantify this in 3 ways. Decreasing revenue the next 3 years by 30% for Marks, 20% for CTR, and 10% for FGL, increasing CTFS's net write-off rate, and decreasing the multiple associated with Alberta-based properties. Together, this results in a share price of $130, which leads us to believe that markets overreacted when the share price fell to $100 in January alongside the tipping price of oil. The next major risk we looked at was the devaluation of the CAD relative to USD. Approximately 40% of CTC's products are sourced in USD, and while management has indicated that these costs can be passed on to consumers, we quantified the impact if they ultimately had to absorb these costs. Our scenario analysis of the continued devaluation of the CAD at 1.4 for 2 and 4 year durations yielded share price discounts of $20 and $29 respectively. The final major risk we identified was Lowe's recent acquisition of Rudder, which has the potential to change the competitive landscape. Based on our analysis, we believe that the primary intention of the transaction is not to capture even further market share, but instead the immediate focus is to continue improving Rudder's tapering profitability through now additional net closures of their combined 550 square foot footprint. Additionally, based on our analysis, we still think that CTC has better pricing and geographic convenience for consumers. Thus, in the short term, we don't think this will have a major financial impact on CTC. In summary, we believe that CTC's strong competitive positioning, growth potential, focus on profitability, and undervaluation derive by recommendation. We'd now like to open up the floor to Q&A. Thank you for your time.
So you've done a great job of going through your segmented valuation and then aggregating it up and a number of the risks and the kind of things we would look at. as analysts, did you take a look at what the street is saying about CTC and how you differ, what the analysts are saying, how you differ, and why you think you've got a better insight on it?
So we've tried to be as objective as we could, so we didn't want to read too many equity research reports, so for that reason we've strayed away from that. We do know what their latest financial results, they posted results, and we know that the market reacted very well to that. So lately they've had a great run since they've released their results. So we think the market's responding positively to their continued financial performance. And we like to think that our valuation is relatively unique for just in general.
Well, just two for me. One, for the real estate valuation, you were using a blended multiple, which was at a premium, or an average multiple, but that was at a premium to both Choice and Crombie, which are food retailers, which are inherently less cyclical than the products that Canadian Tire would sell. So why would you use a multiple that would be higher than a basics? Revenue stream. And just the second question is, and I might have heard this wrong, I think on your target you were using a 35% discount for the sub-voting shares.
Right.
Where did that discount come from? Was it an average from history, or you derived a new one? If you can talk about that.
Yeah, so the first one, why don't we do the voting shares?
Sure. Oh yeah, we can cover the voting shares. So we have the 35% discount. Right now we're trading at about 60% discount to the voting shares. But based on what we value the control premium to be for the difference between the Class A shares and the voting shares, we don't find that management is incompetent. So we believe that that there really shouldn't be much of a discount between the voting and non-voting shares. So we believe 60% is quite high, and so we use 35%, which is more in line with the premium that was there.
And just to go a little bit further with that, so just to sensitize that, we looked at the different averages and we realized, using the different numbers, because there's so few voting shares, it actually has a relatively negligible impact on the target price. So we could have used the 2-year, the 5-year going up and down, and it wouldn't really change that very significantly. In terms of the multiple, we ultimately chose to look at Canadian retail REITs, and we found those to be the most comparable. And the reason why we chose Choice, because similar to CT REIT, they have very large tenants, very stable retail tenants, and though the actual tenant operates in a different segment than CTR does, in terms of stability from a tenant profile, we think they're relatively similar. We also did an expanded REIT comp set, including US retail REITs, and if we had expanded the comp set, the multiple is higher, and that would have given us a greater valuation for CT.
If I heard you correctly, you're forecasting the stock will be up about 13%?
That's correct. So 11% capital, 2% on the dividend.
And how does that compare to the market? What are your expectations? Is it an outperform? Because you didn't really say it's a buy, you just said it should go up. Your expectations are to be 13% return.
So relative to market, so we're not too optimistic about the market this year, but we think that it's going to issue roughly a market return of about 5%. So the majority of the Canadian market is based off of financials and the energy sector, and we noticed that the tapering share price of the TSX has primarily been driven by the WTI. So we ran a correlation on this, and I think it's about Brent, if we go 2 slides down, I think the correlation is about negative. There's a high positive correlation between the WTI and the TSX. So it's not a graph that was displayed, but we have the forecast for WTI, and it's been fair. They're forecasting about $50 a barrel consensus for the end of the year. So if the Canadian markets are fairly correlated to the WTI, then we think, roughly speaking, it's going to be a moderate rate of return for the year. So we still think that our 13% return will outcompete the 5% market return of the TSX.
Right, so just part 2 of that question was, and what has the stock done in the past? What's been its compounded return? Is that comparable to what it's done in the past 10 years?
It's a 5-year. We have a 5-year, 2-year, 1-year. It's performed really well. I think it's returned 70-80% over 5. I think we're having a bit of an issue with the appendix mapping. Forgive the shuffling, I think. But in general, the stock has performed very well.
Okay.
Sorry.
It's beat the TSX. It's beat the TSX as far as on all the periods that we've analyzed it.
Can you guys cover off a little bit about, you did a very thorough analysis on the finances, but e-commerce and business strategy going forward. Can you cover a little bit about that?
Yeah, absolutely. So one thing they're really focusing on, FGL and Canadian Tire, including Marks, is making their stores more robust and more digital. So part of their strategy is, we know e-commerce is going to be a big trend, and it has been a big trend. And actually, their CEO last week said their next acquisition will likely be an e-commerce company or something that helps them expand e-commerce. But they're really focused on getting people off their couches and away from their laptops into their stores. For example, if I were to talk about FGL Sports, they recently opened 4 flagship stores across Canada where they have digital screens across the stores, and they're really trying to get consumers out of that. So to answer your question, e-commerce is part of their strategy, but they've sort of have a two-pronged approach. They want to make their brick and mortar more robust and also build out their e-commerce.
So in addition to that, we recognize the trends in e-commerce, and we realize that some products are inherently just better in store. So for instance, if you're going to buy sporting equipment, you're going to try many different pieces of equipment. So there are some sectors of CTC that are going to be less affected in the short to mid-term by e-commerce, but even in terms of CTR, so general merchandise, that's becoming more online. We took a look at the website analytics for the e-commerce for CTR websites versus its closest competitors, and I don't think we're going to be able to navigate to the appendix. Excellent. So based off of very basic website analytics, we see that 3 things are here. So more people are spending on average more time relative to the competitors on CTR's site, and also in terms of the bounce rate, CTR has a significantly lower bounce rate than its competitors. So CTC is very, very aware of the e-commerce trend, but it's just that some segments are less exposed to the e-commerce than say the general merchandise website. But they are doing well in this segment as well.
Do you worry at all, or do you want to comment on the governance structure with the family owning about 60% of the
Sure, I can do. So I think when we were talking a little bit earlier about voting shares, the value of voting shares comes from what voting shares entail, and that's having a role in management. So the reason why we're comfortable with the voting share and buying the non-voting share is because we, given the company performance, this group of consumer companies that they've built with complementary business models, management has proven to us through their actions and their ability to provide shareholder return that they are competent, that they are doing a great job running the business, and for that reason, I think in terms of governance, we're pretty happy with how it's going at the company. And then in terms of the board of directors, the chairman is independent, so many other directors are independent as well. So it's not just the family making the shots, but rather many people are coming together to make decisions for this company.
Yeah, and if I could just add on to the competency of the management, they were able to successfully spin off CT REIT. We can see through the stock price performance that they've been performing really well, with margin performance, also with revenue growth. And they also successfully acquired and have been expanding FGL Sports over the past few years. So I think that these mergers and acquisitions speak to the competency of management and their success in doing so.
One other thing we liked is some of their top executives have been involved with the various segments, so they really see how the company comes together and how all the segments operate sort of in coordination with one another.
Right, the son's a dealer. The son's a CTR dealer. But no, sorry, that's right.
I guess that similar to Nancy's question with the shift to online, although a little bit different. Do you think changing demographics in the country will have an impact on Canadian Tire, i.e., outside of this assignment or report? When's the last time anyone of you went to a Canadian Tire store?
That's the perfect question. Millennials shop at CTR?
So surprisingly, in addition to running the website analytics, we also ran their social media analytics. So CTR brands itself as the strongest brand of appealing to Canadians. So we realized that the stronger that they connect with a younger demographic, the better odds they have in boosting sales in the future. So in terms of YouTube data, you can notice that in almost all statistics, total subscribers, total daily subscribers, total video views, they outshine their competitors. But also in terms of Twitter and their follower base, they're active in engaging people through tweeting at events, resharing and whatnot. So in terms of the follower quality, in terms of the total followers, average tweets per day, they have a ridiculous amount of activity. So they are keeping on top of trends as best they can and trying to appeal to as many consumers as they can because their most they're the most Canadian conscious retailer, and that's what we like about this company.
Sorry, not to be mean, but just to answer Dave's question, would you guys
You're done.
Somebody say Tom?
Yes.